Has Tesla finally bottomed after this 14-month decline? And is this the time to pick up shares now that we are down about 64% from those 2021 highs? We've already seen a 32% increase in the stock since the start of 2023, which doesn't include the 4% pop in this stock after hours, putting them at a market cap of about 450 billion with a PE of 44. So now that they've just reported their year-ending results, it's time for us value investors to step in here and analyze this business and the results to see whether or not we can get a better idea of where things stand with Tesla and if we should be buying the dip here with the leader in the EV space. Well, make sure to stay tuned to the end of the video as we answer all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. We'll start the video off by walking you through the A to Z's when it comes to the fundamentals here for Tesla. We'll go through the top line, balance sheet, cash flows, everything. We'll discuss the trajectory of the business. And finally, we'll conclude this video off with an evaluation of this business using our intrinsic value calculator. And the last thing we'll talk about is our investment rating here, where we rate the investability of this business. And if you do enjoy this type of content, make sure to like the video, subscribe, because it really helps out the channel. On top of that, make sure to comment your thoughts in the comment section below and start a discussion. With all that out of the way, let's jump into the video. All right, and starting with Tesla's Q4 2022 earnings results, what did they provide us with here? And that's that they had about 37% revenue growth year over year. Now, that comes off the backs of growth in their vehicle deliveries, growth in their other parts of their business, and all the while navigating a challenging Forex environment here where they did have impacts of about $1.4 billion. Now, looking at this chart here from our video sponsor, Main Street Financial Data, make sure to check them out as they are the first link in the description. We can see the vehicles delivered here by Tesla, and comparing that over the last few years here, we can see those really have ramped up, and that is going to naturally translate well across over to their other segments of the business. So their supercharger stations, those are up as well. Energy storage deployed is up. Same thing with solar deployed. And that's why when we get down here to our revenue by segment, obviously with a business like Tesla, their main business does come from their auto segment. And so we can see that direct correlation with the amount of vehicles delivered. Naturally, their revenues will significantly increase in line with that there. So if we take a look at this from a full year perspective here, we can actually see what they've done here with their production. As you can see here across their auto segment and across their business as a whole, you're going to see some significant increases here to not only their production, but also their deliveries. So there is still that demand for this business. And that's exactly what you're going to want to see, especially with some of their models here having over 192% increase into their production there and 167% increase in their deliveries. I mean, definitely something to excite investors, meaning there is a lot of demand for this business. And again, we're seeing how that revenue has been able to expand over the last few years. And especially when you compare that to their competitors in this space, yeah, you can see why Tesla is the leader. Their margins have been improving over time as well. So now they're the leader over there, across the whole auto industry. So no surprise why the stock is up 4% after hours after another strong year. If we look at this from a full year perspective here, we have total revenues coming in at about $81.5 billion. That's a 51% increase year over year. Now, in order to produce those revenues, though, there's quite a bit of cost. So that only leaves them with about $20.8 billion in gross profit. And that is simply because it costs a lot to produce and assemble those electric vehicles. But overall, we're seeing gross margins here of 25%. That has actually ticked up, at least for this year, meaning they are able to slightly decrease the cost to produce those vehicles. And that's exactly what they've been working on here. Operating expenses came in at about $7 billion. So that's only a 2% increase. And so when we look at this from an income from operations perspective, at least for this year, $13.6 billion there, 109% increase, massive growth there. And they've been able to clean up the margins on this side of the board as well with a 464 basis point increase on their operating side of the business. Left them with about $7.5 billion of free cash flow once you work your way down there. Keep that in mind once we get to the end of the video. Before that, let's talk about the cash and the liquidity of this business. This has been improving over the last few years as well. They're now at $22 billion of cash that's just sitting there on the balance sheet. They only have about, let's just call it $3 billion worth of debt. So very, very healthy here in terms of a liquidity perspective. You can see that from this Main Street chart and how the equity has been growing, at least over the most recent history here. Obviously, they were going through some challenges here with profitability. And so the balance sheet wasn't in the best state, but it is looking a lot better now. Again, once we get down to our cash flow section of this video here, again, we already talked about it. They had about $7 billion, $7.5 billion of free cash flows. They're not really rewarding shareholders just yet. There's no dividend. They're not buying back shares. That's fine right now. Right now, they're committed to just paying down the debt that they had on the balance sheet. So definitely a cash rich business. Now, in terms of the outlook here for the business, they're basically saying they're expecting more of the same, where they're planning to grow their production as quickly as possible in alignment with the 50% CAGR target that they have, which would help them achieve their target of 1.8 million cars produced for the end of next year. So expect more of the same there. They're going to really look to ramp up that production there and then get their Cybertrucks into production as well later in the year. So obviously there's some demand here for their products. So we can expect another fruitful year for Tesla here. Now let's look at this last chart here from Main Street, and that is their income overview here, where again, we can see here how they had some challenges of profitability over the last few years, but they've really cleaned that up recently, especially since 2019. And now they've been able to produce profits, at least on a more consistent basis here. So now we're up to low to mid-teens, at least in terms of operating income. But if we expect that this business can produce about $15 billion worth of operating income going into the future on a 10% expected return, they do not currently pay a dividend. And if we expect that, I mean, they have been growing at these rates down here at 50% per year. You know, we saw 100% expansion in operating income this past year. So if we conservatively estimate that on an average scenario here, they can grow these revenues at an average rate of about 30% for the next 5 years, then that drops down to a more stable rate. Let's just call it at 15% for the 5 to 10 years after that. On a 35 PE, the stock should be trading at about $457 per share. Now, before the stock was split, that was actually a price that we've seen before, but now that the stock is split, if we look at our chart here, the all-time high currently is up at $407 per share, but that is what would be expected of this stock price to make a new all-time high if they could grow at these levels here. Now, if we're going to be a little bit more conservative about that in a normal scenario, let's say growth starts to come back down to reality here. You know, if we assume that we're going to have harsher economic environments in the future, not so many people will be able to afford Tesla vehicles, although they are reducing the prices of those vehicles in some parts of North America like Canada and such. You know, this is a much more realistic price down here at $248 per share, over a $100 increase from where we are right now in a very average scenario. Now, in the very best case scenario, let's say they stick with, let's just call it 50% growth rate over the next few years. That drops down to just 25% on the 44 PE like they're currently trading at. The stock would be up into that $1.7 thousand price range. That is huge growth there. But I mean, it's not like we haven't seen that before the stock split either. So definitely achievable, but at the same time, 50% for the next 5 years consistently will be a little bit harder, especially if they are able to grow those $15 billion worth of operating income. You know, the growth will probably slow down. Let's just be a little bit more conservative here and say that they can only grow at 25% for the next few years. Then it's a much more realistic price point here to see the stock price at $675 per share in the very best case scenario. Now, in the very worst case scenario, we're in a hypothetical scenario. Maybe their Cybertrucks aren't able to get produced at the rate that they're expecting. Maybe their production isn't able to ramp up. They have some errors with their facilities, something like that. And then they're only able to grow at like 10% for the next 5 years. That drops down to only 5% for the 5 to 10 years after that. On just a 20 PE, the stock would shrink down to $80 per share. Now, this is extremely worst case scenario. We're talking about some catastrophic events happening with their plans and such. In a more normal scenario here, let's expect that they can grow at, let's just call it, that 10% for the first 5 years. Let's just say they can normalize out at 10% for the next decade or so. On a 25 PE, the stock would still be worth about $120 per share. Really only $20 off where they are currently priced at for a very worst case scenario where they can only grow at just 10% per year on a lowered PE as well. And I mean, we did see this stock price down at those levels just earlier this month. They were at $113 per share. And we've already seen that 30% increase in the stock so far. So we can see that margin of safety price actually kicking in here, where investors have come in here and just absolutely bought that up. Not necessarily signifying a bottom, but that there's definitely some demand in and around that margin of safety level that we just identified. Now, in terms of an investment rating, I'm going to go ahead and give Tesla a 6.5 out of 10. Now, this could have got a higher rating if it was down here in this $118 price range like it was just earlier in the month. Then I think it was probably about a 7.5 out of 10. But right now that it's up to $150 or so per share, I dropped that down just a little bit just because I know I'll be overpaying slightly from that margin of safety perspective, number one. And number two, I don't typically enjoy buying businesses that aren't able to produce recurring revenue from their same customers. I know if you do buy a Tesla, you're probably locked into the ecosystem. You know, after a few years, you might buy a new one, and they do have those solar and energy segments as well that are going to be producing that recurring revenue. But in terms of their main revenue segment with their vehicles, they're just not able to produce revenue from the same customers that I would typically like to see. But for the price down here, definitely for me, a definite buy. But with all that being said, that's my analysis on this stock. Let me know what your thoughts are in the comment section below. Also, make sure to like the video, subscribe as it really helps out the channel. Check out the video's sponsor, Main Street Financial Data. And with all that, I'll catch you on the next one.